All right, let's dive into this Indian stock market outlook for December 2024, shall we? We're looking at a weekly newsletter a listener sent in from Volatility Coaches of India,
Oh, interesting.
dated December 1st. And I got to say, it's got some really thought-provoking stuff in here.
Yeah, and what makes this one especially cool is it's not just, your typical market overview. It actually gets into the specifics of how volatility coaches of India approach things, like the parameters they use for their rebalance volatility certification course.
Yeah, they're RVCC, right?
Yeah.
So kind of giving us a peek behind the curtain.
Exactly.
So let's start with where the market stands, like a snapshot as of December 1st. So the Nifty Y50, India's big index, kind of like their version of the S&P 500, it closed at 24,131.10, which is it's a pretty big number.
Yeah, just thinking about all the companies and, the value that represents.
Exactly. Thousands of companies, billions of dollars.
And the newsletter also points out that the NiftyWise 13-day exponential moving average, or 13 EMA, closed at 23,999.64. Now, for those who don't know, the EMA is like a moving average, but it gives more weight to recent prices. So it's a pretty good way to see short-term trends.
So it sounds like things are, at least in the short term, trending upwards.
Yeah, I'd say so.
Is there anything else in this snapshot that, jumps out?
Well, the VIX, the volatility index, is down to 14.43. That's quite a bit lower than it was the week before.
Okay, and remind me, VIX, that's all about what, market fear?
Yeah, essentially. You can think of it as a fear gauge. The higher the VIX, the more uncertainty or fear there is in the market.
Right. So lower VIX means investors are maybe feeling a little, calmer.
Yeah, more confident, less worried about sudden drops or big surprises.
Makes sense. Okay, so they've got this whole section about their, the RVCC parameters?
Right, the RVCC. They list 5. PE, PB, MG, RSI, and then FII, net open interest.
Whoa, hold on. Before we go any further, can we decode all those letters for our listeners?
Absolutely.
Because I'm sure some people are like, what are they talking about?
Yeah, no problem. So PE, that's price to earnings ratio, basically tells you how much you're paying for every rupee of a company's earnings. Then you've got PB, price to book ratio. That one compares a company's market value to its book value.
Okay.
Which can kind of give you a hint if a stock is maybe overpriced or a bargain. Then there's MG, margin of safety. This is a classic concept, made famous by Benjamin Graham, the OG value investor.
Oh, yeah.
It's all about buying stocks when they're way below what they're actually worth.
So it seems like those first 3, the PE, PB, MG, they're all about making sure you're not overpaying for a company.
Exactly. Getting a good deal, looking at the fundamentals.
What about those other 2?
Right. So RSI, that's relative strength index. This one's a momentum indicator. It looks at how much a stock's price has been changing recently to see if it's maybe overbought or oversold. And lastly, FII, net open interest. That one tells us about the positions held by foreign institutional investors.
Got it.
These are the big players in the market, the institutions that can really move things with their trades.
So basically these 5 parameters, it's like they're looking at the market from all these different angles.
Exactly. Valuation, momentum, what the big players are doing.
Okay. And the newsletter mentions that these RVCC numbers, they've shifted a bit from the previous week, from November 24th.
Yep.
Some more than others.
And one of the big changes they point out is a significant jump in FII net open interest.
Okay, so what's that telling us? What does it mean when those big institutions are making moves?
Well, to me, it says they're getting more bullish on the Indian market, opening more positions, putting their money where their mouth is, so to speak.
So is this newsletter saying, hey, it's a good time to invest?
Well, they project a 5.5% annual return for the Indian market, and they base that on a few things: expected economic growth, dividend yield, and then this interesting concept called valuation reverse to the mean.
Ooh, that sounds fancy. What's that all about?
It's actually simpler than it sounds. It just means that, over time, stock prices tend to go back to their historical averages.
Okay.
So if a market is undervalued compared to its history, it's probably going to go up. And vice versa, if it's overvalued, it'll likely come down.
So they're thinking the Indian market is a bit undervalued right now.
Seems like it, yeah. That's why they're projecting that positive return.
But they don't stop there, do they? They actually give some pretty specific advice.
They do. And it's pretty bold.
What do they say?
They're saying if the Nifty Y drops below 23,000, you should think about converting debt to equity. And if it goes even lower, below 22,000, they say even consider switching gold and fixed deposits, FDs, over to equity.
Wow. That's a big move. They must really believe in what they're seeing.
Definitely. I mean, converting stuff like gold and FDs, that's not something you do lightly.
Oh.
But this is where their whole RVCC analysis comes in, right? They're looking at all these indicators and they're saying the potential upside in the stock market, it's worth it.
Okay, so it's not just, hey, the market's good. It's like, here's how you might actually play it.
Exactly. They're giving us some actionable advice.
So they're liking the Indian market for growth, and they're giving us some specific guidance. What else did they get into?
Well, they dive a bit deeper into certain sectors, and it seems like they're particularly keen on large cap and momentum funds.
Okay, can you break those down for folks who might not be super familiar with, like, the different types of funds?
Sure. Large cap funds, those are the ones investing in the big guys, the well-established companies that everyone knows.
Right.
They tend to be more stable, less volatile than smaller companies. Momentum funds, those are focused on stocks that are, well, on a roll, showing strong upward price trends.
Okay.
But they're betting that that upward momentum is going to keep going.
So they like large cap for the stability and momentum to, well, ride the wave.
Exactly.
Do they mention any specific sectors that they're, like, particularly excited about?
They do. They highlight banking, finance, IT, and pharma as sectors that they think are really well positioned.
Okay, now those are sectors I can wrap my head around. Those are some major players in the Indian economy.
For sure. These are often seen as indicators of like the overall health of the economy. And volatility coaches of India seems to be saying their analysis lines up with their bullish outlook for the whole market.
So putting it all together, we've got this positive sentiment, big investors are getting in, and certain sectors are looking really promising.
Yep. Seems like it could be a good time to keep an eye on India.
Absolutely.
Yeah, it does seem like, December 2024, January 2025 could be a good window. But to really get why they're saying that, we need to understand like where the market has been. And the newsletter, it's got this whole timeline of market trends going back to like January 2022.
Oh, yeah, I was looking at that. It really puts things in perspective. Shows how the Nifty Y50 has been up, down, sideways, all over the place the last couple of years.
And what's interesting is they don't just list dates. They actually point out like specific turning points. Like they say March 17th, 2022, that was a shift towards a positive trend.
Oh, I see.
So it gives you this context for understanding where we are now.
It's like they're market detectives.
Yeah.
So what's the overall story this timeline tells? Is the Indian market just like steadily climbing, or is it more bumpy?
Well, it's definitely not a straight lineup.
No.
There are periods of growth and then, dips and corrections. But I think the main takeaway is it's resilient.
Right,
The Indian market, it bounces back. It's got this history of recovering.
It's good.
And volatility coaches, they're saying the long-term outlook, it's positive.
But they throw in a bit of caution, don't they? They specifically mention some signals from the week of October 20th.
Right, yeah. They're saying, hey, even when things look good, gotta stay aware of the risks.
Got to stay vigilant.
Because markets, well, they can surprise you.
Okay, so it's like be optimistic, but be realistic too.
Exactly.
Right, so there's this table, it's called sectorial index.
Yeah.
And it's a lot of numbers, but I'm wondering, like, what should our listeners really focus on here?
Good question. I mean, it's easy to get overwhelmed with all the data, right?
Yeah.
So big picture first. The Nifty 50, it's actually down a bit on December 1st, but still, right around that 24,000 mark.
Yeah, that's still pretty impressive.
But beyond the Nifty, I'm really interested in the sectors that are showing strength.
Me too. Like, where are things really moving?
Well, the Nifty Mid-Cap 100 and Small Cap 100, those are both up.
Interesting.
Now, mid-cap and small-cap companies, they're considered riskier than the big large-cap companies.
Yeah, makes sense.
But they also have, more potential for growth.
So that's a good sign, right? That people are willing to take on a bit more risk.
Yeah, it suggests investors are feeling confident about the broader economy.
Okay.
Okay.
What about the really small companies, the micro caps?
Right. So the Nifty Y Microcap 250, that one's actually down a little today.
Okay.
But its PE ratio is pretty low, 30.28.
And that PE, that basically means like how much you're paying for a company's earnings, right?
Exactly. And a lower PE, sometimes that can mean a company or even a whole sector, it's undervalued.
Oh, so maybe there's some hidden gems in there.
Could be, yeah. Always worth looking.
So we've seen the strong sectors. Are there any that are like lagging behind or showing weakness?
Well, the India VIX is down a lot, which is generally good.
Less fear.
But it is interesting to see who's not joining the party, so to speak.
Okay, yeah.
FMCG, fast-moving consumer goods, that sector is down. And realty is showing negative change, too.
So even in a good market, there are always going to be some sectors that don't do as well.
Right. It shows how important it is to really pick your spots.
Yeah, it's not just about like riding the overall market wave. It's about understanding the individual sectors.
Exactly.
Okay, so let's tie this back to those RVCC parameters.
Yeah.
Do we see any interesting connections? Like, for example, how does that strong performance in the IT sector, how does that fit with all that increased FII interest we talked about earlier?
That's a great question. Let's see. The newsletter mentions that FIIs are really into the IT sector right now
Okay.
because of strong earnings growth and, the global demand for Indian IT services just keeps growing.
Yeah, makes sense.
And this actually lines up with the high RSI we see for IT in those RVCC parameters.
Right. It's like all these pieces are fitting together.
Exactly. It's not just about, looking at one number in isolation. It's about seeing the whole picture.
Yeah. Yeah, that's what makes this whole deep dive so interesting.
Absolutely. It's not just about summarizing the newsletter. It's about, helping people understand what it all means.
Right. So let's say, someone's listening to this and they're like, okay, I'm convinced India looks good. I'm thinking about investing in December or January. What are some of the key things they should keep in mind?
Well, first of all, even though the overall outlook is positive, markets are unpredictable, right? There's always risk. No investment strategy is perfect.
Right. Got to be realistic.
Yep. Don't get carried away by the hype. Be prepared for things to maybe go down sometimes.
You have good advice.
And also, even if the whole market's doing great, like we said, sector selection is super important.
Yeah. Some are doing better than others.
Right. And understanding why, using those RVCC parameters.
It can really help you make better choices.
Absolutely. So don't just jump in blindly. Do your homework. Understand the different sectors and really think about, your own risk tolerance.
Don't put all your eggs in one basket.
Exactly. Diversification, it's key.
Yeah, spread things out.
It helps protect you if one particular sector or asset class takes a hit.
Diversification, it's like the golden rule of investing.
It really is. And this deep dive, it's just a starting point.
Of course.
Markets change all the time. The Indian market, it's no different. So stay informed, keep learning, and don't be afraid to, talk to a financial advisor if you need to.
Yeah, that's great advice. Investing, it's a journey.
It is.
It's not just a one-time thing.
Exactly.
Well, I think we've covered a lot of ground today.
Yeah, we have.
We looked at the current market. We broke down those RVCC parameters. We looked at trends, sector performance, even talked about some investment strategies.
I think we've given our listeners a lot to think about.
I hope so.
Yeah.
But before we go, I want to leave everyone with one final thought.
Okay.
Let's say you're ready to invest in India. What are some things, beyond everything we talked about today that you should consider?
Ooh, that's a good one.
Like, your own financial goals, how much risk you're comfortable with, even your personal values.
Oh, absolutely. That's such an important point. I mean, this newsletter, our deep dive, it's all valuable information.
Yeah.
But at the end of the day, investing, it's personal. It's about, finding that balance between risk and opportunity.
Right.
And making sure your investments, they align with your own life, your own goals.
Your own values.
Exactly.
So take some time, think about what we discussed, do your own research, and most importantly, invest wisely. Thanks for joining us on this deep dive.
It was fun.
And until next time, happy investing.